While everyone's chasing AI stocks and high-growth ETFs, one old-school asset is quietly heating up silver. And the data shows it's not just a hedge, it's becoming a global opportunity again.
Welcome to Facts Not Forecast, your daily edge in the stock market, facts, insights, and opportunities you won't hear anywhere else.
Today, we're doing a deep dive into the surprisingly complex but highly critical world of global silver investment vehicles.
Right, silver. We're looking at it because, well, the data really points to this unique dual identity it has. I mean, for centuries, it was just seen as, a precious metal, a store of value, simple.
But the sources we looked at, they really hammer home its critical role today as an industrial commodity. It's essential stuff.
Essential how?
For solar energy, EVs, high-tech electronics. That industrial demand creates a pretty major tailwind, something its cousin gold just doesn't have quite to the same degree.
Interesting. So it's got that industrial pull and the traditional precious metal aspect.
Exactly. That dual function is precisely why investors, well, everywhere really, are looking for structured, liquid ways to own it. You combine inflation worries with this rising industrial demand, the whole green transition thing.
Silver ticks both boxes.
It really does. But as anyone who's ever bought coins knows, physically owning silver, it involves risks, right? Purity questions, storage costs, insurance hassles.
Yeah, definitely not straightforward.
Which is exactly why these exchange-traded products, ETPs, they've just exploded in popularity. They solve a lot of those problems.
Okay, let's unpack this then. Our mission today, as I see it, is to break down how investors in three key markets, the U.S., the Europe, and India, are getting that physical silver exposure, but digitally.
And critically, we need to understand not just which funds they're using, but why the actual legal structures behind them can be so different depending on where you are.
That structural difference.
Yeah.
That feels like the key nugget here, doesn't it?
Absolutely. Let's kick off with the U.S. market. It's often seen as the global standard, certainly for liquidity. And here, the ETPs, they tend to be structured as grantor trusts.
Grantor trusts.
Okay.
And the elephant in the room there has to be the iShares Silver Trust, ticker SLV.
That's the one. It's just massive. Dominates the landscape. Assets under management, AUM, we're talking over $27.4 billion USD.
Wow. 27 billion.
Yeah, it's the go-to for huge liquidity. Big players can move serious capital in and out quickly.
And how does that grantor trust structure work, basically?
So in the U.S., the structure means the trust physically holds the metal, usually in vaults in London, and it aims to track the LBMA silver price.
LBMA, London Bullion Market Association.
That's the global benchmark price, quoted in U.S. dollars per ounce or host. Now, SLV gives you amazing liquidity, but it does come with an expense ratio of 0.50%, 0.5%.
Okay, 0.5%. So if SLV is the giant, what about its challenger? The data mentioned the Bruden Physical Silver Shares ETF, SIVR. Calls itself the lower-cost alternative.
That's right. SIVR, its AUM is smaller, around $3.68 billion USD, but its main selling point, its big draw, is that significantly lower expense ratio, just 0.30%.
30 basis points. That's quite a difference.
It is. And like SLV, it holds the metal physically. In SIVR's case, it's with JP Morgan Chase Bank, also in a secured vault in London.
Okay, wait. So they both hold physical silver, track the same LBMA price, vaults in London. But SIVR is, what, 40% cheaper on the fee?
Yeah.
Why does SLV still have nearly 8 times the assets? Is it just inertia, or is there more to it?
It's a mix, but liquidity is a huge factor for really large institutional investors, hedge funds, that sort of thing. The sheer size of SLV means they can trade huge blocks without moving the price too much. That's critical for them.
Right, the bid-ask spread, slippage.
Exactly. But here's a really important structural point we need to hit on. Both SLV and SIVR generally operate on an unallocated basis.
Unallocated. Okay, that term sounds important.
Okay.
What does it mean for an investor, especially someone who likes hard assets?
It's crucial. Unallocated basically means you own a general claim against the silver held in the vault. Think of it like a bank deposit. The bank owes you money, but not specific bills. If the vault provider, the bank, were to face serious financial trouble, well, you're essentially a creditor.
Ooh, okay. So not quite the same as having your specific bar set aside.
Precisely. And that contrasts sharply with a different structure found just north of the border. The Sprott Physical Silver Trust, PSLV.
Ah, PSLV. That's the Canadian one, right? based in Toronto, and it's structured differently.
Very differently. It's a closed-end investment trust, not a grantor trust like the U.S. ones.
Closed-end trust. Okay, and the big deal there is?
The big deal for a certain type of investor is that PSLV focuses on holding fully allocated physical silver bullion.
Fully allocated. Let's nail this down. Unallocated is like a clean check for a coat. Allocated is?
Allocated is like they've tagged your specific coat, or in this case, your specific silver bar. It's segregated. For hard asset investors, this is huge. It minimizes counterparty risk, ensures clear ownership separate from the custodian's finances.
Even if maybe the tracking isn't always quite as tight as the big ETFs because of that closed-end structure.
Sometimes, yes, there can be premiums or discounts to NAV, but for those prioritizing physical security and allocation, it's a trade-off they're often willing to make.
Fascinating. The details really matter here. But, okay, here's where the sources said it gets really interesting, especially for a typical U.S. investor holding any of these physically backed silver ETPs. Taxes.
Yes, this is a critical nuance and honestly often missed. The U.S. documentation is clear. SLV, SIVR, and generally PSLV too, they're treated as collectibles by the IRS for tax purposes.
Collectibles.
Yeah.
Like artwork or stamps.
Yeah.
Not like regular stocks.
Exactly, and that means the tax treatment is different. Standard long-term capital gains on stocks, they max out at a certain rate, right? But the maximum long-term gains rate on collectibles, including these silver ETPs, can go significantly higher, up to 28.00%.
Wow, 28%. That's a massive difference compared to typical stock ETF gains.
It is. So when you're choosing high liquidity like SLV, lower cost like SIVR, or that fully allocated metal with PSLV, you absolutely have to factor in your holding period and these potential tax consequences. It's not the same as buying SPY.
That's a huge takeaway. Okay, so that covers the main structures in North America. Grantor trusts, closed-end trusts, allocated versus unallocated, and the tax hit. Let's hop across the pond now. Europe, you said it's a different approach.
Completely different, generally speaking. In the UK and Europe, you mostly see exchange-traded commodities, or ETCs.
ETCs, right. Why the shift from the U.S. trust model? Is it just regulations?
It's largely down to the European regulatory environment, like UCITS rules, which often favor structuring these commodity products as debt instruments. So ETCs listed on exchanges like the London Stock Exchange, LSE, give you that silver exposure, but the underlying structure is often debt.
Debt instruments.
Yeah.
Interesting. But they still track the silver price.
Yes. Crucially, like their U.S. cousins, they typically aim to track the same global benchmark, the LBMA silver price, house day.
Okay, let's look at a couple of examples the sources mentioned. First, the Invesco Physical Silver ETC, SLVP. The highlight there seemed to be the cost.
Yeah, remarkably cheap. The data shows an expense ratio of just 0.19%, really low.
19 basis points, that's tiny.
It is. And its performance has been strong lately, reflecting the silver rally. The NAV total return was up something like 64% over 1 year in the data we saw. Structurally, it uses certificates that are collateralized with physical silver bullion.
Okay, and then there was the X-Trackers Physical Silver ETC, OXA6. The description there used the term structured debt instrument. That sounds different.
It is different. That's the key structural point. OXA6 is issued by Deutsche Bank AG. It's effectively a bond or a note, but it's collateralized by physical silver.
A bond backed by silver.
Essentially, yes. Its performance has also been very strong, up around 58% NAV over 1 year, and the expense ratio is reasonable at 0.40%. But fundamentally, the investor is holding a debt instrument issued by a bank.
Okay, so let me make sure I get this straight off. With the European ETCs like SLVP or OXA6, I might get lower fees, especially with SLVP, or easy access on local exchanges.
Right.
But I'm taking on a different kind of risk compared to the U.S. trusts. It sounds like counterparty risk because it's fundamentally debt from a financial institution, even if it's backed by metal.
That's precisely the critical analysis. The U.S. grantor trusts are specifically designed to legally separate the assets from the sponsor's own finances. Bankruptcy remoteness is the idea.
Whereas the ETCs?
Being debt instruments, they inherently introduce some level of counterparty risk related to the issuer, although it's significantly mitigated because they are physically collateralized. But for European investors, these products are convenient, track the global benchmark, and trade easily in their local currencies.
Got it. Different structures, different risks, tailored to the region. Okay, let's pivot again. A completely different market context, India. The sources suggest that things are really booming there.
India is fascinating. Silver isn't just an investment. It has this immense traditional and cultural significance, right? People buy it for festivals, weddings. It's a core part of family wealth.
But usually physical bars and jewelry, I imagine.
Historically, yes. And that came with all sorts of issues. High local markups, questions about purity, storage concerns, just like anywhere else, but perhaps even more ingrained.
Which makes the rapid growth of their ETP market really compelling. The data showed huge inflows. And the key difference there is the benchmark they track.
Exactly. Unlike the US and European funds tracking the London dollar price, LBMA outs, Indian ETFs track the domestic price. MCX Silver, quoted in Indian rupees per kilogram, INR kg.
MCX, that's the multi-commodity exchange of India.
That's the one. So these funds are designed to give returns that match physical silver priced in rupees per kilo. That's what's relevant to the local investor. And the enthusiasm is huge because they bypass all those old problems with physical metal.
The sources highlighted two main players, both pretty new, launched in early 2022. Nippon India Silver ETF, SILVERBEES, was one.
Launched Feb 2022, and the interest was just immediate, almost explosive. Think about this. The one-year fund flows into SILVERBEES, according to our sources, hit 70.50 billion INR.
70 billion rupees in a year for a new silver ETF.
It tells you everything about the demand for a modern, secure way to own silver in India. Performance was solid, too, up about 53–54% over the year.
And its main rival, ICICI Prudential Silver ETF, SILVERIETF, launched just slightly earlier.
January 2022. And the data we saw actually showed even stronger performance for ICICI's fund over that one-year period, something like a 66.75% price gain. Plus, its expense ratio was competitive at 0.40%.
So what's the big picture takeaway for India?
It's modernization. These vehicles give Indian investors digital access to physically backed silver, managed passively. They completely sidestep the traditional risks of storage, insurance, and especially purity checks that always came with buying locally.
Okay, this brings us nicely to the kind of aha moment, maybe. Why use these ETPs instead of just buying bars, especially if you're internationally mobile?
Right. The core benefit across all these structures, SIVR in the US, SLVP in Europe, SILVERBEES in India compared to holding physical bullion, is really about liquidity and portability.
Portability? How so?
Well, think about it. When you hold one of these ETPs, you own a fractional liquid interest in physical metal, right? But you don't have the logistical nightmare. No storage vaults, no insurance policies, and crucially, no customs declarations or cross-border transport headaches if you move country. Okay. So if I live in the UK holding SLVP and I move to the US.
You could potentially just keep holding it if your broker allows, or, more likely, sell it easily and buy a US equivalent like SIVR or SLV with minimal fuss and cost. Try doing that with a suitcase full of silver bars.
Right, nightmare. Customs declarations, finding storage.
Exactly. The shared feature across all these markets, US, UK, India, is that commitment to being physically replicated and passively managed. They aim to mirror the spot price in their specific currency, dollars per ounce, or rupees per kilogram.
So that standardized approach, even with different legal wrappers, makes silver a truly global liquid asset accessible through these ETPs.
Precisely. It democratizes access. Whether you're a giant institution trading SLV, a cost-conscious European investor buying SLVP, or a retail investor in India systematically investing in SILVERBEES, you get physical exposure without the physical friction. Okay, so wrapping up, the main finding seems clear. Silver is definitely active, attracting huge capital globally. And the modern, efficient way to get exposure is through these physically backed ETPs, tailored to each market, whether you're tracking the dollar price, LBMA, or the domestic rupee price, MCX.
Absolutely. But if you're listening and thinking, okay, I get the vehicles, maybe I should add some silver, analyzing the ETP structure is only part one. Part two is timing and strategy. And one metric that consistently popped up in the source commentary was the importance of tracking the gold to silver ratio.
The gold-silver ratio. Explain that briefly.
It's simply the price of gold divided by the price of silver. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio fluctuates, and when it's very high, it can suggest that silver might be undervalued relative to gold.
So it could signal a potential catch-up opportunity for silver.
That's the idea some analysts follow. It raises a key question for you to consider. If gold holds its value, or even climbs due to global uncertainty or whatever reason, how much upside could silver have just to get back towards more typical historical ratios?
That's definitely a provocative thought, a key metric to watch if you decide to take this knowledge and apply it.
Something to track. Appreciate you tuning in.
Until next time, stay sharp, stay patient, let the market work for you.